Okay, hopefully most of the people have joined by now. I hope you'll gain a better understanding of new tax law by the end of this webinar. This webinar will not concentrate on tax planning strategies, although we will focus on educating you on new tax laws relevant to most of our client needs. The Tax Cut and Jobs Act, TCJA, certainly a mouthful. I am just going to call it the new tax law. So you'll have heard me refer me here into the new tax law, and that will be the TCJA, the new tax act. So let's start and get into the program. So in the old tax law, we had 7 tax brackets, 10% to 39.6%. In the new tax law for the years 2018 to 2025, it expires most of the personal aspects of this tax act expire in 2025, where the business aspects are made permanent. So we have 7 levels of taxation again, but they are lower levels. So the 10% rate remains at the 10% rate, but the 15% rate goes down to 12% rate, 25, 22, 28 goes down to the 24% rate, so on and so forth. And these are the single cutoffs of taxable income and married filing joint. As of the date of this webinar, the head of household status brackets have not been released. So, but also not only are the tax rates slightly lower, when they take effect are slightly higher. So that certainly helps as far as paying a little bit less in taxes. There are other tax strategies or tax aspects of this law that do not help. And then the increase in tax rates generally do not make up for the difference of some of the deductions that are lost. So continuing on, some of the differences are the increase in standard deduction for single filers from $6,500 to $12,000. So now the new standard deduction is $12,000 for single filers as opposed to the $6,500. The increase in standard deduction for head of household is $18,000, up from $9,550, almost double. And again, for married filing joint, the standard deduction goes from $13,000 to $24,000, almost double on that case as well. However, we have the elimination of the personal exemptions for yourself, your spouses, your children. In the old tax law, there was a $4,050 deduction for your personal exemptions. In the new tax law, there is none. There is an increase in the child tax credit to $2,000 per child, and these are for families making up to about $400,000. So the old credit was $1,000, and the limit was much lower. So again, there's some give and take. So we lose our personal exemptions, but we get a higher child tax credit and get a higher limit for child tax credit. The biggest hit for Long Islanders is the state and local income tax, commonly referred to as SALT, and real estate taxes combined are limited to $10,000 only, no matter how much you pay. And we'll talk about a little bit of strategy on this one because it's all over the news. You see people waiting online in News 12 or what have you for its tax assessor's office. So we'll talk a little bit about this strategy. There's no more expense for unreimbursed employee business expenses. So when a lot of people in the service industries, a lot of firemen, a lot of police officers, teachers, they had a lot of unreimbursed employee business expenses. These are no longer deductible. Also salespeople who travel a lot and don't get reimbursed for the mileage, used to have big expenses. Now that that is not going to be deductible, unfortunately. One thing that is a little bit better is medical expenses are deductible for any amount over 7.5% of your income. That used to be 10%. And there was talk about that going away altogether, but fortunately they kept it and lowered the limit to 7.5%. So for example, if you make $100,000 in income, only the amount in excess of $7,500 will be deductible. So if you had $10,000 in medical expenses, only $2,500, the amount over $7,500 would be deductible. Some more limitations. The move-in expense deduction has been eliminated, unfortunately. Home equity loan interest is no longer deductible. The old law was $100,000 of home equity loan. The interest associated with that would be deductible. home mortgage interest deduction has been limited to the first $750,000 of the loan for mortgages originating after December 14th, 2017. If your mortgage originated before December 14th, 2017, it's subject to the old limits of $1 million of mortgage interest. Not mortgage interest, but the amount of interest associated with $1 million. Up to $2,500 of student loan interest is still deductible. It's subject to some income limitations, not available at this time, unfortunately. Here's a big one. Teachers still can deduct $250 for classroom supplies as an adjustment to income. I was actually kidding if it's a big one, it's a small one, but every little bit helps, right? So the 529 education plans have been expanded to include not just college, but up to $10,000 a year in distributions that can include public, private, or religious schools for elementary or junior high or high school. So that's a expansion of that deduction. And then the American Opportunity Credit and Lifetime Learning Credit for college students remains the same. That has not changed. So let's just summarize where we are right now. So most of these things we talked about, except the corporations, which we'll talk about in a few minutes. But just as a way of summary, here is the prior law in blue. And then in this purple magenta color is the new law. So the child tax credit, $1,000 was deductible and refundable. Now it's $2,000, and the refundable portion is $14,000. So the refundable portion means that you can get it back even though it's above and beyond your tax liability. For instance, let's go with the new law. Let's say your tax liability was $1,000, and you had one child. In that case, the $1,400 credit, or the $2,000 credit, $1,000 will wipe out your tax liability. $400 would be refundable to you because that is the refundable portion. It can go above and beyond your tax liability. So we mentioned 7 individual rates. There's still 7 individual rates, but the rates are somewhat lower. Excuse me. And they start at a higher income bracket. So that's a good thing, although it doesn't offset some of the other bad things or things that hurt you. Standard deduction, we mentioned almost double. Married, filing joint from $12,700 to $24,000. Single, $6,350 to $12,000. And head of household, $9,350 to $18,000. C corporate tax rate for C corporations went from 35% maximum rate to 21% flat rate. Pass-through income for S corps and LLCs, and by the way, you don't need to be an S corp and LLC. You can be a sole proprietor. You can own rental property outside of an LLC, although good idea to own it in an LLC. In the old law, they were the same as the individual rates for pass-throughs. In the new law, there is a 20% deduction, and we'll talk about that in a little bit of detail because it's not as simple as it seems. In some cases, it's simple. Some cases, not so simple. So the alternative minimum tax used to be a 26% and 28% rate, and the corporate was at a flat 20% rate. The exemption has increased dramatically for the alternative minimum tax on the individual side, and the corporate side is repealed. Don't think it's such a big deal on the individual side, because most of our clients who were an alternative minimum tax, if not all of them, were an alternative minimum tax because of high real estate taxes and high state income taxes, and maybe some unreimbursed job expenses. All of that has gone away now. At least the state income tax and real estate tax is limited to $10,000. So I can't see how anybody will be in alternative minimum tax, except for some special circumstances, but certainly not for real estate taxes, state income tax, and unreimbursed business expenses since they went away. In review, again, personal exemption went from $4,050 to $0, repealed. State and local taxes used to be deductible, now maximum of $10,000, including the real estate taxes. And that's not a married filing joint, still $10,000. And mortgage interest went from a $1 million limit to a $750,000 limit, again, for mortgages closing after December 14th of 2017. So a lot of people are prepaying the real estate taxes. So there's some issues that we got to be careful with. So if you're on alternative minimum tax, and it varies by each individual, of course, then prepaying your state, your real estate taxes or your state income tax really does not help you on a federal level. Prepaying your real estate taxes will help you on a state level. So that's something to consider whether you want the state tax deduction this year or next year. But if you're an AMT, alternative minimum tax, paying your real estate taxes early will not help you. Also, if your real estate taxes are being paid through your bank escrow on your mortgage, you need to coordinate that with the bank. You've got a day or two left to do that. Or you can choose to prepay your real estate taxes even though they are escrowed, and then the municipality will refund your taxes. Whether they refund them to you or your bank is a question of the municipality, and then you'd have to wait to get them back. So it's a cash flow issue. You would get those real estate taxes back, deduct them this year if you're not in the AMT, but it would take a while to get them back. The municipality has to sort this out. They may pay back the bank as opposed to you, and then you got to get it back from the bank. So just something to consider. And the other thing is real estate taxes must be assessed, and we'll talk about this in the following slide. So a lot of words here, but assess means they need to be billed. A lot of people are paying their real estate taxes based on an estimate on a previous bill. Technically, the IRS advisory is saying that prepaid real estate taxes may be deductible only if assessed. So let's go through two examples. And this is just purely reading right off the screen. Example 1, assume County A assesses property tax on July 1st, 2017 for the period July 1st, 17 to June 30, 18 on July 31st, 2017. County A sends notice to resident notifying them of assessment and billing the property tax in 2 installments, with the first installment due September 30th, 17, and the second installment due January 31st, 18. Assuming the taxpayer has paid the first installment in 17, the taxpayer may choose to pay the second installment by December 31st. The check just needs to be cut, does not have to be cleared, and may claim the deduction of prepayment taxes in 2017. Plain vanilla example, pretty straightforward. The town I live in, town of Brookhaven, that's exactly what they do. So they send the tax bill out in December, and it's due by January 15th, I think, and January 10th and May 31st, but it's assessed, so we can go ahead and pay that. Other municipalities, not so much. So let's look at example 2. County B also assesses and bills its residents for property taxes on July 1st, 2017, same time period. For the period July 1st, 17 to June 30th, 18, County B intends to make the usual assessment in July 2018 for the period July 1st, 2018 to June 30, 2019. However, because county residents wish to prepay their 2018 and 19 property taxes in 17, County B has revised its computer system to accept prepayments of property taxes for the 2018-2019 property tax year. By the way, a lot of municipalities are not doing this and sending money back. The taxpayer who prepaid their 2018-19 taxes will not be allowed to deduct a prepayment on their federal tax returns because the county will not assess the property tax for 2018-19 until July 1st of 2018. That being said, you still may want to take the chance of prepaying your real estate taxes because you may lose that deduction in 2018. So, but you never know. The IRS may send out mass letters questioning people's real estate taxes and wants to see a bill. And you're saying, well, what's the big deal if I pay them other than cash flow issue, and the IRS sends me a letter to ask me about my real estate tax payments and send the real estate tax bills in, and they see that it was for payments for real estate taxes not assessed. Well, that's fine. You'd lose a deduction you don't get on the federal level that you don't get anyway, but you may lose that deduction on the state level in 2018. So that's something to consider, and we can talk to you about that in more detail if you want to call the office or use a Q&A or what have you. Let's get the screen there. So some other items on the individual taxes. The healthcare initiative, the healthcare penalty is repealed, but this is for 2019. So as far as 2017 and 2018 is concerned, the healthcare penalty called individual mandate is still assessed. So if you don't have health insurance in 17 and 18, you're subject to a penalty. A couple of other minor differences, not minor, but this is a big difference. Alimony treatment is reversed. So the old rules were the person paying the alimony can deduct the alimony on their personal income tax return. The person receiving their alimony would be taxed on their tax return on the alimony received. So with new divorce agreements, the alimony is no longer deductible on the person paying for it and is no longer taxable on the person receiving it. And as the slide says, this provision will only apply to divorce agreements after December 31st of 2018. So 1031 exchanges, commonly called like-kind exchange, usually used for real estate. Sometimes you see it for other things like trucks or cars or other business assets. Well, the new law just now is exclusive for real estate. Other assets, such as classic cars, airplane, boats, we've seen it for trucks a few times, is not subject to 1031 exchange, tax-free exchange. Another good thing with the law is increase of depreciation limits for business cars. The old law had luxury automobile limits on depreciation, luxury automobiles being defined as automobiles of $34,000 and up, and doesn't sound like too much of a luxury automobile to me. But the depreciation was limited. That limitation has gone away now, and it significantly increased the deductibility for business cars beginning in 2018. So it used to be much better to lease a car from a tax perspective as opposed to buying. This brings this into a little bit more parity. So again, we can just do the analysis if you want, if you're a business owner. Another business expense is the crackdown on business entertainment expenses. So you used to be able to deduct 50% of your entertainment expenses. If you bought theater tickets, if you bought sporting tickets, you can write 50% off. That has been eliminated. What does remain is the 50% for food and beverage expense. So if you take somebody out for lunch or dinner, you can still deduct 50% of that as the old rule. If you go into a sporting event or theater, you can deduct the meals associated with that, but not the actual entertainment expense. Excuse me about the cough in there. Just not used to talking this much. Being married, I'm used to listening. So the flexibility, another provision is flexibility of a rollover 401k loans. So if you borrowed money from your 401k and you terminated services for whatever reason, you went to a new employer, you got laid off, your business, your job closed, the business that you work for closed, you had to repay the 401k loan back immediately, or you'd be subject to a tax, and if you're under 59.5, a 10% penalty. There's a 60-day grace period now for people who have terminated services. So that's a good thing. You have 60 days to pay back your 401k loan. Also, another minor thing, employer tax credit for Family and Medical Leave Act. If somebody took a family and medical leave and the employer paid for their salaries, they get a 12.5% credit of the salaries paid. C Corp, business taxes. The C Corp tax rate is lowered to 21% from 35%, as we talked in summary above. This will not help most small businesses, as C Corps are still subject to double taxation. This means that profits are taxed at 21%, but if you, the owner, take out any profits, it's also taxed at your individual return rate, whether that be 15% for dividends or your regular individual income tax rate. This is a good strategy if the client is the person who's doing very well. They can leave the money in the C Corp. Maybe he takes a salary of $200,000 to $300,000 to live, and then leaves a considerable amount of money in C Corp being taxed at the 21% rate. Then when that person retires, he decides to take it out of the C Corp as a dividend at 15% rate. But other than people being very wealthy and want to park some money, which I don't see very often, I don't see the C Corp helping out very many small business owners. So pass through income under the threshold. So there's this talk about this threshold, which we'll get into in a minute or two. But the new law wants to help small businesses. C Corps are getting their tax rate cut. What about S Corps and LLCs? Most of our clients are organized as S Corps. S Corps themselves do not pay any tax on their profit. Their profit passed through to the owner and are only taxed at the owner's personal tax rate on their return. Most of our S Corps are specifically service trades. This means doctors, lawyers, consultants, financial planners, accountants like myself, and any business that relies on skill of the owner, except for engineering and architecture, services which are specifically excluded. Why? I'm not sure. They probably had a better lobby than us. But anyway, that is the law. The law is designed to make sure that the lower tax rates are not abused. To accomplish this, they have added income limitations. Keep in mind that if you sell a product, you do not have to worry about the income limitation. It's only for a specific service or trade. So the threshold is 157 for single filers and 315 for married filing joint filers. If your income is under this threshold, then the calculation is relatively simple in tax terms. Anything is relatively simple in tax terms. The deductible amount of your business is simply 20% of your qualified business income, QBI, with respect to each business. So it's not per individual, it's per business. QBI is a profit with W-2 or the salary of the owner added back into business expenses. So to go through a simple example, if your income is $100,000 and your salary as the owner is $60,000, your QBI is $40,000. Pretty simple. $100,000 less $60,000 because the salary is excluded gives you $40,000. Then your deduction is $8,000, 20% of your QBI, qualified business income. So that's on a pass-through entity. So if your income is over the threshold, 157,000 for single filing and 315 for married filing joint, then the calculations are more complicated. So if your income is, there's a threshold. If your income is between 157 and 207,005 for single individuals, or 315 to 415, there's a phase out. If you're over these limits, then you lose your deduction completely if you're a personal service business or specified service business. If you're not a service business, then your deduction is based on a formula. We're not going to get into this too much, but in that case, the old pass-through rules apply. So if you're over the threshold limit, you just pay on your regular income tax rate. The calculation only applies to single taxpayers with income between the threshold, so there's a phase out, and married between 315 and 415. The calculation only applies to a select few people. Because of this, we will not spend any time on it. I'm going to go through the next slide and show you what it looks like. The slides will be on our website, but basically, if you're in that phase out between the 157, 207, or 315 to 415, you can, Formula A figures 20% of your qualified business income. Formula B is the greater of yada, yada. Anyway, if you want us to look into this, we could, but it's too deep for this discussion. A couple of more points and we will be wrapping up the webinar, and then we can get into Q&A if anybody is still interested. Crackdown on deferred compensation. So if people have non-qualified deferred compensation and there's no substantial risk of forfeiture, if you can't lose that money, then it's not tax deductible. So you have to pay tax on it at that point. Another smaller provision of the new tax laws, sexual harassment settlements are not deductible if they are subject to a non-disclosure agreement. So in the past, sexual harassment settlements were deductible. Now they're still deductible, but not if they're subject to an NDA, a non-disclosure agreement. So that wraps up our webinar. Yeah, I want to thank a few of my staff people. I want to thank Kara for coming into the office tonight during her vacation, helping answering some questions. I would also like to thank Alessandro for his many PowerPoint revisions, IT guidance, and general hand-holding through this, our first webinar. So thank you all. Again, thank you, the clients and people participating, very much for your time. And if anybody has any questions, I'm happy to answer them. Otherwise, you can call or email the office. And if I do not speak to you, have a happy, healthy, and prosperous New Year. So one of the questions is, where is the PowerPoint available? The PowerPoint will be available on our website in a couple of days. Would anybody be able to get a copy of the PowerPoint? Yes, you can download it off our website. You're welcome. Somebody wanted to go back to the 20% slide for pass-through entities, S corps or LLCs. So we'll go back to the simple example. Hopefully this is what you're referring to. If you're referring to the phase out between 157 and 207 and 315, 415 for married filing joint, I'd like to take that off this webinar. It's a little too complicated to go through on this webinar, but I'd be happy to talk to anybody one-on-one on that. So some more clarification on the 20% of the deduction for qualified business income. So it's just that it's a 20% deduction on what counts as qualified business income. So you take your regular business income from your S corp or your LLC or your Schedule C, so proprietorship. You add back your salary, and then you multiply that by 20%, and that will be your deduction, which you take as a adjustment. Somebody's asking about the 401k changes. And those 401k changes are just for if somebody borrowed money from their 401k account and they have an additional 60 days to pay it back after they're terminated from service. Either if they leave to go to a new employer, they get terminated from service, they get let go. The old law was you had to pay back the 401k loan immediately. The new law gives you a 60-day provision to pay that loan back before you're taxed on it. So it gives you a 60-day grace period. So question is a 20% is a 20% deduction is an adjustment to your taxes, basically deduction on a front of your return is called an adjustment. Is it rest taxed at your regular amount? The answer is yes. The rest of the income is taxed at your regular amount. One question is the SALT going down to 10,000 hurting me more than my rate going down from, let's say, 25% to 22%? Generally, yes. I mean, it varies person to person, but generally the loss of the SALT is not offset totally by the drop in income tax rate and the higher threshold to get into that income tax bracket. Somebody wants to know, are deductions for home office expense excluded now? Yes, deductions for home office expenses are excluded. Those are unreimbursed employee business expenses. Unless you're self-employed and have a Schedule C, a sole proprietor schedule, if you're an employee, those are not deductible anymore. The 529 deductions works the same way when you contribute to a 529, so they have not changed. 529 contributions are not deductible on the federal level, but they are deductible on the state level, and only if you invest in the New York State 529 or your state if you're in another state. But the big thing in the 529, this is my commentary here, is not the state tax deduction of 7%, but the gain of the investment being tax-free if you use it to pay for college education. That to me is the real benefit. It's nice, the 7% deduction on the state is a cherry on top, but if you've been investing since your kids are young or just born, and now they're college age, you should have, especially with this rising market, and it doesn't always rise, but you should have a tremendous amount of gain, and that's tax-free, and that to me is a better benefit. But the 529 rules have not changed as far as contributing. People are asking me about the AMT. How do you know if you're an AMT? Well, you can certainly call the office, but if you go to your tax return, your 1040, your page 2, and you look at line 45, alternative minimum tax, if that has a positive number in it, then you're on alternative minimum tax. Question, do I have to go to town hall to pay taxes, or can I put a check in the mail? Put a check in the mail. You don't have to be like one of these people seen on TV. So as long as the check is cut on or before December 31st and mailed on December 31st, you're fine. As a consultant, can I change my billing to indicate selling written procedures instead of services? Suppose you can. That's a little grayer. We need to fine tune that in the office or over the phone, one-on-one. Are there changes to the state tax laws? Not that I'm aware of. So right now, no state tax law changes. So your real estate taxes are still deductible on the state, and your state income tax were never deductible on the state. Question, overall, do you think that it was good for the middle class that this tax cut happened? I think for the 6 states that have high income taxes, it hurts the people. I think for the rest of the country, it's good. I think if you're making less than $100,000 and don't own a home, you're doing really well with it. But the middle class in Long Island who have high state income taxes, who have high real estate taxes, it's generally hurting them, even though they get a slightly lower tax rate. And that tax rate is at a higher income level, slightly higher income level. The net effect generally is that people are hurt in Long Island by this tax cut. For personal income tax, it sounds like they raised the threshold for the AMT. Yes, that is correct. But again, the AMT, the alternative minimum tax, most of the stuff that put my clients into the alternative minimum tax, the high real estate tax, the high state income tax is limited to $10,000, and the unreimbursed employee business expense, the home office, the travel, the uniform, all of that goes away. Will you have a recording of this phone call available? Yes, for those of you who have trouble sleeping or want to torture loved ones, it will be on our website and it'll be on YouTube as well. What happens when this tax law expires? I don't know. My guess is as good as yours. Well, it goes back to the old tax law. But I'm sure it's going to be dealt with before then. And when Trump leaves the administration, they may change it by then anyway. A client is asking if their Florida real estate taxes are deductible in New York if they pay them. Yes, your real estate taxes are deductible in wherever you pay them, deductible in New York if you're a New York State resident. Are there any changes to Social Security or Medicare taxes? No changes to Social Security or Medicare taxes. Charitable donations remain the same. I think the limits have increased. It was limited to 50% of your adjusted gross income. I think that has gone up. But, other than being more favorable, charitable donations have not changed for the worst. That being said, a lot of people are going to be taking the standard deduction of $12,000 or $24,000 or $18,000 because their state and local taxes and real estate taxes are limited to $10,000. It depends on where they are in their mortgage. If they're later on in their mortgage and they don't have a lot of mortgage interest, then they'll be taking standard deduction. All right, I think I've answered all of the questions. Seems like most of the questions anyway. Questions are slowing down. I'll give it another minute or two. And then again, I want to thank everybody for participating. Wish everybody a happy, healthy, prosperous New Year's. And please, by all means, call or email the office with any specific questions that you may have. Okay, it doesn't seem like there's any more questions, so enjoy your evening. I'm going to go home, have a scotch, relax, and again, happy, healthy, profitable New Year to everybody. Thank you for your time.